Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer tool. And I'm very proud to present to you a very comprehensive tutorial on our new and improved performance report that subscribers have on FastGraphs. I want to really emphasize how important this performance report can be into giving you insights on understanding investing and how investing works so much better than ever before. So it's a rather long tutorial, but I do encourage you to watch it to the end. Those of you who followed my work for a long time know that I'm very fond of saying measuring performance without simultaneously measuring valuation is a job half done. And although that is true, it really brings to bear a very, very important concept about measuring performance. Number one, just measuring the performance of a stock over the last 3 years or 4 years or 5 years without knowing how the performance was created and where it came from is simply a job half done. Because there are components about performance that investors should be very cognizant about when they're evaluating stocks. The valuation at the time of the beginning of the measurement period is critically important. The growth rate of earnings of the company from the time it was recorded becomes very important. And then the valuations throughout the time period also become very important. So measuring performance without simultaneously measuring valuation is a job half done, but you could also add measuring performance without measuring valuation and growth rates is a job only partially done as well. So we're going to go in here and show you how the new performance report on FastGraphs can enlighten you to become much smarter and more intelligent investors, where you not only know what the past performance has been, but you know why and how it was created. Let's get into the tutorial. I'm going to start with the cyclical company Cummins, and I'm going to orient you. This is the performance report. I'm going to go to the historical graph first because I want you to see the things. I've shortened this to a 13-year time frame. Let's go ahead and add it to a 19-year time frame here. Okay, so what you see here is a cyclical company with earnings growth of 10% that started out fairly valued and is ending very close to fair value. Okay, so we should have something that really mirrors that growth rate. Now, when I go into the new FastGraph performance report, let me first of all orient you to some of the features of the graph. First of all, you can change time frames as you always could, even on our historical graph. Second of all, you can create comparisons by adding tickers. Here we're going to compare it to the Standard & Poor's 500, but if I put in other tickers in here, I can also do that, and I'll show you that towards the end. But the real key is everyone talks about whether you can beat the market or not. Now let's look at Cummins, and let's look at it from this time frame by the features that we've added with these two graphs. The first graph we have is the cumulative change in price and earnings. In other words, what we're measuring here with this graph is how fast earnings grew and how fast prices grew. And I'm using the compound annual growth rate to do that. You also have the option of looking at cumulative change. So with cumulative change, you can see the percentages of growth. With the compound annual growth rate, you're seeing the annualized rate of return of the growth, okay, which I think is equally important. But here's what I want you to understand about this. You're able to then look at a performance comparison. And for example, in this long-term time frame here, if I'm going from the very beginning where Cummins was measured against the Standard & Poor's 500, I see that the compound earnings growth rate for Cummins was 10.79%. The compound earnings growth rate for the market was only 6.06%. So advantage Cummins. So it's not surprising to see that Cummins has outperformed. The blue line on the graph is higher than the orange graph. From a price comparison, we see that the price of Cummins grew by 9.5%, which is close to the earnings growth rate of the company, discounted for that slightly lower valuation, which we'll get to here in a moment. But when I look at the market, we see that the price was 8.09%, where it outperformed its earnings growth rate, but it still underperformed the price performance of Cummins by almost 2 percentage points, or a percentage point and a half here. But now let's evaluate this graph, and let's look at where performance came from. Let's now go to the valuation comparison. All right, this is showing by pointing to any time frame here, you get very important data. For example, if I'm going here to the beginning, we're seeing that Cummins was trading at a PE of 16.8, and the market was trading at a 19.15 PE. The fair value for both of them would have been estimated to be 15 multiple. So Cummins was less overvalued than the S&P 500, which was more overvalued. All right, now we also can look at this graph and recognize that the periods where Cummins outperformed the market were periods when the valuation was very, very low relative to the market. Like here on October 24th, we see the Cummins had a PE of 6.7 compared to the market at the same time, at the same date, of a PE of almost 17. And you can see that Cummins, therefore, outperformed the market. The blue line was higher than the orange line. Now, on the other hand, when you see a period of time where Cummins had a higher multiple, here we see the PE on December 24th, 2010 of Cummins was 21, where the market was almost at fair value at 15.9, and we see that the market outperformed Cummins over the next 2 or 3 years. Measuring performance without simultaneously measuring valuation is a job half done. So what you can look across this graph and see that periods of undervaluation were the most opportunistic times to invest in Cummins, also the most opportunistic times to invest in the market. But the earnings growth rates over the time frames are also important. So let's move to another example here. Let's go to Broadcom, stock symbol AVGO. And this is a very interesting graph. I'm going to shorten the time frame here to about 15 years so that you can see, actually we'll shorten a little more so you can see it in comparison to the market. Now, starting with cumulative price change, we see that AVGO had a 14.22% compounded annual rate of return versus the market, which only had a 10.42% annualized rate of return. We see the earnings growth of AVGO was 26.37. The earnings growth of the market was only 7.31. Okay, so clear advantage to Cummins. It grew faster, and every aspect it outperformed it. Now, if I go to the valuation comparison, once again, we see, if I point to this, we see that AVGO had a slight advantage of a PE of only 17.6 versus the market's higher PE of 18.18. But because AVGO had higher growth, it had a fair value PE calculated at 30 where the market was at 15. But what we see here, because of the performance of growth, that AVGO dramatically outperformed the market. Now let's draw different time frames here, and let's just look at a shorter time frame here. So now, if we're looking at the period of time starting in 2017 here, we see that AVGO had a price appreciation of 29.21% versus price appreciation for the market of 11%. Earnings growth of the market was 8.96%. Earnings growth of AVGO was 17.17. So again, faster growth and better capital appreciation, better performance over time. Now, when you compare the valuation comparison, it gets even more enlightening because here we see, if we go to the beginning, that AVGO only had a PE of 16 on October 31st, 2017. The SPY had a PE of almost 21. Again, AVGO was undervalued with a fair value of a PE of 30, where the SPY was overvalued with a fair value of 15. And we see then through that period of time that the high valuations of the market were very high during that period of time. And we see that AVGO outperformed the market almost all periods of time. Let's shorten that a little bit more, and we can see that more clearly in that we have the blue line above the orange line in all aspects simply because we have faster growth and we had better valuations at the starting point. If you look at 2019 here, on October 31st, AVGO had a PE of under 14. The market still had a PE of almost 20, 19.41. Again, advantage AVGO in every aspect, including earnings growth of 17.98%, but price appreciation of 41. But I also want to point something out at the end here. If I go to the ending period of time here, we see that AVGO had 373.3% compound annual growth rate of price, and we had 104% of earnings growth, where SPY only had 66% growth in price and only 36% in compound annual growth rate. So again, we can change these figures here to give us different looks at it. You can look at the cumulative change in percentages, or you can look at the compound annual growth rate, which gives it to you in percentage numbers. And the point again is you can see high valuation for the market, low valuation for AVGO. You can see higher earnings growth for AVGO versus lower earnings growth of the market, and it's no mystery why AVGO outperformed the S&P 500, but we can see that throughout all the periods of time. If I move on now to Amgen, the world's largest biotech company, we get another interesting picture here, and I'm using the 7-year time frame because I want to make a point. The market outperformed Amgen in this case. The price comparison was the market did 11.5% versus only 3.47% for Amgen. Okay, going down to the valuation comparison, the market for Amgen, the PE was 16, the market was 22. But here's the kicker. At the end, when I'm going from point A to point B, what happened was, if I point to this thing here, the valuation of Amgen was only 14.7, where the valuation of the market was a multiple of 23.76. So what happened was, even though if we look at the numbers up here, we see that the earnings growth of the market was 7%, and we see Amgen's earnings growth was only 5.87%. But the valuation advantage clearly created a time where the market outperformed Amgen mainly because of valuation and earnings growth. But again, if I change time frames, I can get different pictures here. I'm going to do the 20-year time frame here. And what we see here with Amgen is we see earnings growth of 9.82% versus earnings growth of 7.75. We see annualized rate of return for price of 8.4% versus annualized rate of return of 7.7%. And what we see here again is we get an advantages in valuation and growth. But I do want to make a point as I look at this. The periods where the blue line was below the orange dotted lines here, the dashed lines, which are the fair value reference lines, both at 15, the blue and the orange line are both at 15, you can see that Amgen was undervalued, and during this period of undervaluation is where they outperformed the market over the next several years, where the market was overvalued and it underperformed Amgen over those years. You can see the outperformance of the blue line up here versus the orange line. Valuation matters, and it matters a lot. But it's not just important to know how valuation happened and where it came from, or just that it did happen. It's also important to know how and where it came from. Another example I'm going to use here just to drive this home a little bit, let's go ahead and look at Ameriprise. I'm looking at a 20-year time frame here. Ameriprise grew earnings at 13.45%. The S&P 500 only grew at 5.5% during this time frame. Ameriprise gave a compound annual rate of return of 12.57. The market only gave an annualized rate of return of 7.75. So we had advantages of growth. But then if I go down here to the valuation charts, we also want to see that Ameriprise had an advantage in valuation. So they started out at a lower value, grew faster, and therefore outperformed the market in almost every period on this graph here. That's critically important. Now, last but not least, I want to kind of summarize all this by bringing in IBM. If we look at IBM over the 20-year period here, or even the max period, what we see is that the market dramatically outperformed IBM over this long-term time frame. The market price appreciation of 7.84, where IBM only did 4.09%. But I also want you to see that there are periods where IBM dramatically outperformed the S&P. Now, if we go down to the valuation charts, the periods where IBM outperformed the S&P were during periods where the valuation was very low, but also earnings growth was very high. Now let's drop this down just to illustrate this point even more clearly. Let's drop this to a 6-year graph, okay? Because IBM went through a transition period, but for the last 6 years, IBM has outperformed the market by a rate of 16.7% versus only 10.31% in the market. Earnings growth for the market was 16.12%. Earnings growth for IBM was only 5.19%. So in this case, the market grew faster than IBM, but it was all about valuation. And the starting period of the 6 years here, the market was trading at a valuation of 27.97. IBM was trading at a PE of 15. So the real advantage here was IBM stayed at a much lower valuation the whole time, but yet it outperformed the market. A quick look at the historical graph and you see why. We only had 5% earnings growth, but we had reasonable valuations. We have an ending period where we have a high valuation of 2023. Looking at the same time frame and looking at the S&P 500, I want you to note that the S&P 500 was trading at 27.9 PE, and even though it had much higher growth, and even though it ended at a slightly lower PE, but still a very high PE, the fact that IBM is still outperformed the market because it started out at a much lower valuation. And again, you see that clearly with the performance reports. Now, I want to just summarize this. You can run different time frames. You can see the periods of time where IBM outperformed the market. You can see it was starting periods of low valuation, going to better valuation, or simply headwinds of very high valuation for the market, and so on. So with this graph, you can basically evaluate how the company performed. Now, additional stuff on the performance report is the classic, just putting it into numbers. You know, a $10,000 investment in IBM on the starting date here of January 2021 would have increased to $16,000 versus $13,000 for the market. That gave you an annualized rate of return of 16.86% versus 10.25% for the market. And in this case, by the way, we're not reinvesting dividends. We also had a total dividend advantage of $1,600 in dividends versus less than five, just slightly less than 500 for the market. So the bottom line is we ended up with a 20% annualized rate of return in IBM versus 11%, almost twice the performance over the last 6 years. And yet IBM was at a disadvantage on growth, but a superior advantage on valuation. And IBM's dividend even grew at a lower rate. Because once again, if we go to the historical graph, we see that IBM grew rather slowly here, but now the price has skyrocketed to where it's gotten overvalued. And the fact that it still grew at a lower rate than the market, the advantage here was that the market was at a massive disadvantage because it started out the same time frame at a massive overvaluation, where even though they grew at almost 13% versus 5%, you could say 2.5 times faster than IBM, because it was so highly valued, it was not able to perform with IBM. In fact, it underperformed IBM. All right, so the performance report gives you a totally new edge in investing. It lets you understand not only how valuation happened and where it came from, it lets you compare things sensibly. Just because the stock went down for the last 5 years, for example, it was massively overvalued, doesn't mean that the company didn't perform. Companies can have great performance in terms of operating results and very poor stock. And you can say that about the stock market in general in this 6-year example using comparing IBM to the market. You know, the market grew at a pretty good rate during this period of time. But the problem is that it was so overvalued that it wasn't able to keep up. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, giving you this rather comprehensive tutorial on the very powerful new performance report by FastGraphs. It not only helps you understand what the performance of a company was, it allows you to compare the performance against other entities. You know, I didn't show that in the video, but you could add up to 3 different entities to compare them, and you can compare